Do me a favor. Pass that gravy boat down here. Not the little one, the big one. Your mother really outdid herself with the roast today.
Here you go.
Look at that crust. That is structural integrity right there.
It smells incredible.
Yeah.
It's just good to be back at the table. Honestly, it's been a week.
I can tell. You've been staring at that pile of mashed potatoes for about 5 minutes like it's a spreadsheet that won't balance.
No, I haven't.
Usually you're the first one asking for seconds. You got that look, kid.
What?
The 1,000-yard stare. I see you over there nodding along to your uncle talking about the weather and the playoffs, but the lights are on and nobody's home.
Is it that obvious?
To me,
Yeah.
I've seen that look across my desk for 30 years.
Oh, yeah.
That is the very specific facial expression of a guy who looks successful on paper, great degree, vice president title, nice suit, but who is secretly doing mental math on the ceiling tiles.
Mental math.
Because the cash flow isn't flowing the way the Excel model said it would.
Yeah. It's just... the headlines. I feel like I'm in a vice. I'm trying to make moves, I'm sitting on cash. I'm waiting for the rates to drop so I can finally refinance a house, maybe look at an investment property. The plan was solid. But every morning, I open up the terminal, and it's a new fire.
A new fire every day. I know the feeling.
Gold is hitting numbers that don't make any sense. The White House is screaming at the Fed. I'm getting these insurance letters. I feel paralyzed.
Paralyzed. That's the word. That's exactly it. Listen to me. Forget about the game for a minute.
Okay.
We're going to have a different kind of conversation right now.
Yeah.
Not the everything is fine talk we give your mother so she sleeps at night.
What kind of talk then?
We're going to have the CFO to CFO talk. Because I'm seeing things on the wire, real ground truth signals that the news just isn't explaining properly. And you need to know this stuff to protect what you're building.
You think I'm missing something. I read the journal, I watch the business channels.
I think you're reading the headlines, but you're not seeing the mechanics behind them. The world moved fast in January, like tectonically fast.
It did feel that way.
And if you're operating on last year's logic, this idea of wait and see, this soft landing fairy tale, you're going to get run over. We need to secure the perimeter. So you ready to actually digest something other than potatoes?
Yeah. I'm listening. What's the read?
Okay, let's start with the horizon scan. The macro reality check. You're stressed about a recession, right?
Of course.
That's why you're hoarding cash in a checking account that's probably getting you, what, 0.1% interest?
Everyone is stressed about a recession. The yield curve has been inverted forever. The vibes are off. It all feels so fragile.
That's the paradox, isn't it? It feels fragile. But look at the data that just dropped this week. U.S. GDP hit 2.5%.
2.5%. That beat the forecasts?
It beat every forecast on Wall Street. Every single one. And unemployment, it's stabilized at 4.5%.
4.5 is. I mean, that sounds pretty healthy. That should be good news.
In a vacuum, yes. But here's the key insight, the thing you have to get your head around. The economy is growing, but the cost of existing is exploding.
The cost of existing.
We are in a no-landing scenario. Imagine a plane that never touches down but just keeps flying while the price of the ticket triples mid-flight. That's where we are. The Fed met yesterday, January 28th. What did they do?
They kept the Fed funds rate at 3.50 to 3.75%.
Exactly. They paused. And here's the thing you need to burn into your brain. The insurance cut is dead.
The insurance cut? What's that?
You know the narrative that's been floating around for the last 6 months? This idea that the Fed would cut rates just to be safe, to prevent a recession before it even starts.
Yeah, I've heard that. A preemptive cut.
Powell took that idea out back and shot it yesterday. He explicitly cited that surprisingly strong growth as the reason not to help us. He basically said, you guys are making money, GDP is up, so you don't need a rate cut from me.
So we're just stuck at this level. But, I mean, that doesn't explain why I feel so squeezed, even though I got a raise last month.
That's the silent killer. See, it's not the mortgage rate that's getting you right now. It's all the non-negotiable friction costs. Did you happen to see the insurance reports out of Georgia and Colorado this week?
I saw some headlines about premiums going up, but I didn't dig into the actual numbers.
Home insurance premiums rose 28% in those states. 28%.
Wow.
That's not inflation. That's a structural reset. For some people, that's a whole other mortgage payment in itself. And it's not just houses. Healthcare premiums for 2026, they jumped 18%.
18% in a single year. How is that even possible? Is it just labor costs?
It's labor, sure. But a big driver is the GLP-1s.
The weight loss drugs, you mean Ozempic and that kind of thing.
Exactly. Everyone is on them now. They're miracle drugs, sure,
Yeah.
but they cost an absolute fortune, and the insurers are just passing that bill right back to your monthly premium.
So my healthcare costs are going up because of a drug I don't even take.
That's how it works. So you've got this booming economy, GDP is up, but your insurance and your health costs are eating your liquidity alive. You're running faster just to stay in the same place.
It feels like the assets I actually hold are getting shaky, too. It's not just the cash flow. Did you see what Tesla did?
I did. That's the other big signal nobody's really unpacking.
He just stopped.
Tesla officially ended production of the Model S and Model X yesterday. Done. Finished. Musk is pivoting the whole company to robots.
It's crazy. I have a friend who just bought a Model S 6 months ago. He basically realized yesterday that his brand new car is now officially legacy tech.
And that's a brutal lesson in depreciation, isn't it? Legacy assets, gas cars, older EVs, older tech in general. They're losing value way faster than anyone expected. But now look at what is gaining value. Gold.
I saw that, $5,300 an ounce. I couldn't believe it.
$5,300.
Yeah.
It smashed the record. Now, you have to ask yourself why. It's not because people in the suburbs are suddenly buying more necklaces. It's the wealth transfer. The data shows that China is dumping dollars to buy physical bullion. They are aggressively swapping U.S. Treasury reserves for actual physical gold. They don't trust the system.
It's a geopolitical hedge. They're de-dollarizing their reserves.
It's a vote of no confidence in the dollar's long-term stability. And frankly, if you look at what's happening in Washington, can you blame them?
The political situation is tense.
Tense is an understatement. This Fed meeting yesterday wasn't just a pause, it was a brawl. We had a 10-2 split. Governors Waller and Mirren actually voted to cut.
Wait, a split decision? I thought the Fed always tried to present a united front.
Usually. But this is a historic dissent. The Fed is literally fighting with itself in public. And outside the building, the White House is escalating attacks on Powell.
I saw something about that, a DOJ probe.
The DOJ is probing his home renovations? Come on, that's leverage, that's political pressure, plain and simple. And the market knows it. That's why the 10-year Treasury yield didn't go down when they paused. It climbed. It hit 4.24% almost immediately.
Because the market is pricing in the chaos, the political risk.
Bingo. It's a political risk premium. Volatility is the new normal. So let's map this all out. We have a growing economy, but costs are skyrocketing. We have a fractured Fed, and gold is telling us big players are scared of the dollar. This is the landscape, and you're sitting there waiting for things to calm down.
Yeah.
This is the calm. This is the eye of the storm.
Okay, that's pretty sobering. But if this is the reality, what do I do? How do I navigate it? Because my entire strategy, my whole plan has been wait for lower rates. I'm sitting on a 7.25% mortgage I took out last year, and I've been telling myself, just wait for the fives. Just wait for the five.
Right, let's unpack that. This is the first protocol in the grand scheme. We call this the Fed floor protocol.
The Fed floor.
And the core argument is simple. Waiting is no longer prudence. It is pure speculation. You are speculating against a bond market that is pricing in structural inflation for the long haul.
But the banks, I mean, even Goldman Sachs was saying a cut was coming in March. I built my whole budget around a refinance in March.
Was past tense. As of this morning, Goldman officially shifted that forecast.
They did.
They pushed their rate cut prediction from March all the way out to June 2026.
June. That's another 6 months from now.
Exactly. So if you're waiting, you're just losing 6 months of potential savings to chase a target that keeps moving further away. And do you know why they moved it?
I'm guessing it has to do with what Powell said.
He explicitly blamed tariffs for the price overshoots.
I did catch that in the press conference. He called the inflation tariff-driven.
Right. And here's the economics of that. This is the technical part you really need to understand. You cannot use interest rate hikes to fight a tariff. A tariff is a tax. It's a government policy. It raises prices structurally. It sets a higher floor for rates, period.
So the whole baseline is just higher now?
Correct. The days of 3% or 4% mortgages, they belong to a globalist economy that simply doesn't exist anymore. We're in a protectionist economy now. That means a higher neutral rate, which means higher mortgage rates maybe forever.
So this is the new normal.
And on top of that, Powell declined to give any forward guidance. He's flying blind. So my question to you is, if the chairman of the Federal Reserve won't tell you where rates are going, why are you betting your family's entire financial solvency on a guess?
It's a psychological trap, you know? Mortgage rates are at what today, 6.18%?
They stabilized at 6.18% as of yesterday's close.
Right. And I'm sitting here thinking, if I can just get 5.9%, I'll feel like I won. It's so hard to let go of that specific number in my head.
You're stepping over dollars to pick up pennies. You're paying ridiculously high interest on consumer debt. I know you still have that credit card balance from the trip to Italy, while you're waiting for a magical 5.9% that might never actually come.
When you put it that way.
Think about it like this. This is a good dinner table fact for you. That 6.2% rate available today, it isn't just interest, it's an insurance policy.
An insurance policy against what?
With the White House attacking the Fed and the DOJ circling, there is a very real scenario where all this political chaos causes foreign investors to dump U.S. bonds. If that happens, rates don't go to 5%, they go to 8%. Locking in a rate now ensures you against Washington burning the whole house down.
That makes sense. It's hedging the tail risk. But, okay, rates are only half the equation. My big issue is the monthly nut. It just feels heavier and heavier every month.
And that leads us directly to the second protocol, the cash flow defense. We start thinking about wealth, net worth on a piece of paper, and start thinking about solvency. Can you pay the bills on the first of the month? Yes or no?
Right, solvency.
Inflation has migrated. It's not in the price of flat-screen TVs anymore. It's in services. It's in the mandatory stuff.
Like the insurance premiums you were talking about.
Exactly. Look at this. Foreclosure filings jumped 14% this year. And guess where the leader is? Florida.
But Florida is booming. It's not in a recession.
That's the point. Florida is booming. So why are people with jobs losing their homes?
Because they can't pay the monthly bill.
Because of the shock of ownership costs, insurance, and taxes. People are fully employed but going broke because their escrow payment literally doubled in 2 years. You have to weaponize inflation against itself. And the only tool you have to lower your fixed costs, your principal and interest, is a refinance. You lower the P&I to create breathing room for the surging insurance and tax bills.
So it's not about saving money overall. It's about creating a buffer in the monthly budget.
It's about creating margin. Look at retailers. I saw a report that big retail chains are focusing on margin over growth this year. They're cutting costs to survive. Households need to do the exact same thing. Prioritize your monthly cash flow margin above all else.
It's funny you mention these costs getting passed to us. I ordered delivery the other night, don't tell your mother, and there was a regulatory response fee on the bill.
Let me guess. $6. In New York City?
Yeah. How did you know? I was furious. I almost deleted the app right there.
That's the future, kid. Compliance costs are always passed down to the consumer. Basel III bank fees, the new capital requirements for banks, they're coming for mortgages next. You're going to see it. But going back to the house, did you know insurers are using drones now?
Drones? What for? To spy on houses?
To look at roofs. If your roof is older than 11 years, their algorithms flag it. They are canceling policies or tripling the premiums without a human being ever visiting your property.
11 years. That's barely half the life of a modern roof.
Doesn't matter. The algorithms run the show now. A renovation refi to fix that roof is way cheaper than the force-place insurance they'll stick you with. It's a defensive move.
You know, connecting this back to the healthcare hike, it's like,
Yeah.
You need an Ozempic mortgage.
The what? Say that again?
The Ozempic mortgage. Think about it. Healthcare costs just went up 18%, partly because of these new weight loss drugs. You literally have to lower your house payment just to afford your body payment.
I love that. I am absolutely stealing that. But it's 100% true. Your health is eating your house. You have to balance the scale somehow.
Okay, so cash flow is defense. I get that. But I'm also looking at my other debts. I've got the car note, the student loans, the credit cards. It just feels like I'm leaking money from a dozen different holes.
Which brings us to the third protocol, the debt migration arbitrage. And I'm telling you, this is the highest ROI move available to anyone in your position right now.
Arbitrage is a strong word. That usually implies a risk-free profit.
This is as close as it gets in the real world. You're swapping toxic debt for fixed debt. Look at the consumer distress numbers. Delinquencies are rising, not because people are losing their jobs, but because wage growth is finally cooling off. You cannot out-earn a 25% APR on a credit card. It's impossible.
And the credit card balances are so sticky, they just hang around forever. You pay the minimum, and the principal barely even moves.
Here's a canary in the coal mine for you. Home Depot just got 800 corporate jobs.
Really? I would have thought people were still renovating like crazy.
They cut those jobs because the cash-out refi boom dried up. People aren't pulling cash out of their homes like they were 2 years ago. That signals that lenders are retreating. The window to access your equity is closing. You need to get that liquidity while the window is still open.
I never would have connected the Home Depot news to lending. I just figured it was general retail weakness.
It's always about credit. It all comes back to credit. And look at tuition. It rose 2.9% again this year. But PLUS loans for grad school, they're at 9% plus fees. Your mortgage equity is sitting there at 6.5%. It is mathematically, undeniably cheaper to borrow from your kitchen than it is to borrow from the government.
Plus, the interest on the mortgage is tax deductible in most cases.
Exactly. And let's talk about that Tesla news again. Let's call it the Tesla lesson. Imagine paying 9% interest on a Model S that the company just officially canceled. You are paying high interest on a rapidly, visibly depreciating asset. It makes no sense. Move that debt to the house. The house is appreciating, or at the very least, holding its value.
It stops the financial bleeding.
And there's a hidden risk with ELOCs right now that nobody's talking about. I watch the regional banks like a hawk.
The commercial real estate exposure.
It's a bomb, a ticking time bomb. There is a $1.8 trillion worth of T-maturity wall hitting these banks. They are terrified. And when banks get scared, what do they always do?
They tighten credit, they hoard cash.
They freeze lines of credit.
Why?
In 2008, people woke up one morning and their 8 ELOCs were just frozen,
Yeah.
gone.
Yeah.
If you are relying on a revocable line of credit for your emergency fund, you are walking on incredibly thin ice. You need to swap that revocable line for an irrevocable fixed loan, cash in the bank.
That segues perfectly into what I'm probably most worried about, which is just access to capital. If the banks are getting scared, shouldn't I be hoarding cash in my checking account?
That is the Liquidity Fortress Protocol, protocol number 4. And the core idea is this. Access to capital is quickly becoming a privilege, not a right.
Is that just because of the commercial real estate losses?
That's part of it, but there's a bigger factor at play, sovereign crowding out.
Explain that one to me. I haven't heard that term.
Governments around the world are borrowing billions upon billions for sovereign AI clouds. They're building massive national security level data centers. Now, who do you think a bank prefers to lend to? You, to fix your roof, or the U.S. government to build a defense AI?
So the government is basically sucking up all the available lending capital in the system.
You are directly competing with Uncle Sam for a loan, and the government will always win. That keeps rates high and credit tight for everyone else. And then there's the issue of shadow inventory.
That's the homes that are vacant, but not actually listed for sale, right?
Exactly. And rising shadow inventory suggests there's a hidden supply glut waiting in the wings. If that supply hits the market all at once, appraisals could soften pretty quickly. You want to lock in your home's value now while the comps are still strong.
So the strategy is get a cash-out refi.
Cash is king. Cash out to pay off all that toxic debt, but, and this is the most crucial part, you keep a reserve. You don't spend it all on toys or a new car. You put the fortress money into T-bills or a high-yield savings account earning 5%.
So I'm borrowing at roughly 6.5%, but I'm earning 5% on the cash I'm holding. The net cost of that liquidity is
About 1.5%.
Yeah.
Maybe even less after the tax deduction. That is the cheapest insurance policy you will ever buy.
It's kind of like the China gold rush we were talking about at the beginning.
That's it. That's a perfect analogy. China is dumping dollars for gold as a hedge against instability. You are cashing out home equity to diversify your assets and create a cash buffer. It's the exact same strategy, just on a micro level. You're taking some chips off the table.
Okay, I'm starting to see the whole matrix here. It's not about finding the lowest rate. It's about restructuring your entire financial position for resilience. But let's talk about the house itself. You mentioned legacy tech with the cars. Is the house itself becoming legacy tech?
That is the final protocol. Protocol 5, the life cycle shift. It's about structural adaptation. Your home isn't just a shelter anymore. It's a power plant, it's a nursing home, and it's an office.
A nursing home. You mean for us? We're not that old yet.
I mean for your aunt,
Yes.
for your parents. The silver tsunami is here. Nursing homes are costing $8,000, $9,000, $10,000 a month now.
God, I know. Her place is costing the family a fortune. They're absolutely bleeding dry.
It's a solvency threat to the entire family unit. Building an ADU, a granny flat in the backyard via a renovation financing loan, is a survival strategy. It adds value to the house, sure, but more importantly, it saves the family fortune from being wiped out by elder care costs.
And with all the return-to-office mandates coming down.
RTO is hitting 5 days a week in a lot of places. Plus, they're talking about taxing commuter benefits. If you live near a transit zone, your property value is safe. But you might need to renovate for efficiency if you're spending less time there, but need it to work better when you are.
What about energy? I've been reading a lot about the strain on the power grid.
Solar capacity jumped 21% last year. You know why? Because these new AI data centers are draining the grid. Grid anxiety is real. Energy independence, having your own solar panels, your own batteries, that's a major equity value add now. It's not just a green thing, it's a security thing.
It's future-proofing the asset.
And think about obsolescence. Smart homes with AI prediction tech, biometric security. A home without this stuff in 10 years is going to be like a car without Bluetooth is today. It's a depreciating asset.
That's a terrifying thought. The idea of the house itself becoming obsolete.
It's the reality.
Yeah.
But look, we've covered a lot of ground. The macro storm, the cash flow defense, the debt arbitrage, the liquidity fortress, and the structural life cycle shift.
It's a lot to digest, but it all connects. It changes the goal from get the lowest rate to something much bigger like survive and thrive.
Exactly.
Yeah.
Which brings us to the grand scheme, the tactical execution. Here's what I want you to do. I want you to stop acting like a consumer waiting for a sale on aisle 5. I want you to start acting like the CFO of your own family.
Okay, CFO hat is on.
Your goal is not the lowest possible interest rate. Your goal is the lowest products. Total monthly mandatory outflow.
Minimize the burn rate. Got it.
Correct. We execute a strategic refinance. We consolidate all the credit cards into one payment. We fix the roof so the insurance company doesn't drop you. We maybe buy the solar panels to cap your energy costs for the next 20 years. And we secure a significant cash buffer. We replace all those volatile, scary, variable rate debts with one single fixed number.
And that number is tax deductible and, most importantly, stable.
And it lets you sleep at night while everyone else is panicking about what Jay Powell is going to say next month on TV.
Yeah.
Do that and you're secure. Now, seriously, pass me those potatoes.
You've definitely earned them. You've earned them.
This is Jay. Jerome Powell.
Mm.
Normally, you hear me from behind a podium reading a statement that's been scrubbed by 18 lawyers and 12 economists.
Right.
We speak in Fed speak, not to be obscure, but because words move markets. A misplaced adjective can cost a pension fund $1 billion. But tonight, after this meeting, after the dissent, the noise from Pennsylvania Avenue, and the sheer complexity of the data we're looking at, I felt it was necessary to sit down and just talk.
Yeah.
No Q&A, no reporters shouting over each other, just the thinking behind the gavel.
Okay.
We held rates today, 3.50% to 3.75%.
Yeah.
I know the market wanted a cut. I know the home builders wanted a cut. I know the president demanded a cut. And I know Chris Waller and Stephen Mirren, two brilliant minds on my committee, voted against me to cut.
Mm-hmm.
The 10-2 split, it keeps me up at night. It's the first real fracture we've had in this cycle. But let me take you into the room and explain why we paused and why patience isn't just a word we use to buy time. It's the only safety line we have left.
Right.
Let's start with the surprise, the economy. We were looking at GDP growth that is, frankly, well, it's resilient, surprisingly strong. We're tracking at a pace that defies the recession narrative that's been peddled for 2 years. The consumer, they're complaining, yes, but they are spending. Businesses are investing, particularly in this AI build-out. If I cut rates into an economy growing at 2.5% to 4%, what am I doing? I'm pouring gasoline on a fire that is already burning quite nicely on its own. The insurance cut narrative, the idea that we should cut just in case, is dead. You don't buy fire insurance when the house isn't smoking. You wait.
Right.
But the real beast, the thing that made me hold the line, is inflation. It's somewhat elevated. That's the polite phrase. The reality is stickier. We've killed the demand-driven inflation for the pandemic. That's gone. But now we're dealing with structural inflation. Tariffs. I spoke about this today, but I want to elaborate. When the administration imposes tariffs, import prices rise. We see that in the data right now. That isn't inflation caused by you buying too many toasters. It's inflation caused by policy.
Right.
If I lower interest rates, does that remove a tariff? No. Does it fix the Red Sea shipping routes? No. Monetary policy cannot fix trade policy. If I cut rates while tariffs are pushing prices up, I risk unanchoring inflation expectations again. I risk the 1970s. And I will not be the chairman who let the genie back out of the bottle because the political heat got too high.
Yeah.
And let's talk about that heat. You saw the headlines. White House escalates attacks. The Department of Justice probing my renovation disclosures. The talk of shadow Fed nominees.
Right.
I want to be clear, and this is as close to angry as I get. This institution, the Federal Reserve, stands on a foundation of independence. That isn't for my ego. It's for your dollar. If the bond market believes that the Fed chair takes orders from the Oval Office, The 10-year Treasury yield doesn't go to 4.24% like it did today. It goes to 6%. It goes to 8%. Investors demand a premium when they think the currency is being debased for political votes. When I said stay out of politics to my successor, I meant it. The moment we start setting rates to help an incumbent or hurt a challenger, we are no better than the central bank of a banana republic. The DOJ probe. It's noise. It's leverage. I've been a lawyer and an investment banker long before I was a regulator. I know how the game is played. We will comply, we will show the receipts, and we will show up to work the next day and set the federal funds rate based on PCE data, not DOJ subpoenas.
Right.
But I want to address the dissent. Governor Waller. Chris thinks we're too tight. He thinks the neutral rate, R-star, is lower than I do. He argues that by holding here, we are passively tightening as inflation falls. He's not wrong in theory. But my fear, and the fear of the majority, is the head fake. We saw in the 70s, inflation comes down, the Fed celebrates, cuts rates, and then wham, it roars back up because the labor market never actually cracked. We see the labor market stabilizing. 4.5% unemployment. That's not a crisis. It's normalization. Wage growth is cooling, yes, but look at the construction sector softening. Look at manufacturing mixed. It's not falling off a cliff, it's landing. And when you're landing a plane, you don't shove the nose down at the last second, you glide.
Right.
Now, housing. I know. I see the foreclosure filings, up 14%. I see the Florida data. I see the freeze. I get letters, thousands of them. Chairman Powell, you're killing the American dream. Chairman Powell, I can't sell my house. It brings me no joy. But I have to be honest with you. The Federal Reserve cannot fix the housing market structural problems. We broke the lock-in effect slightly. Inventory's up 20%, but prices aren't crashing because there's still no supply in the places people want to live. And the cost's killing you now. Insurance, taxes, repairs, interest rates don't fix those. If I cut rates to 3% tomorrow, home prices would skyrocket again, and we'd be right back where we started. We are accepting weakness in housing to save the dollar. That is the trade-off. It's a brutal calculus, but my mandate is price stability for the whole economy, not asset appreciation for the housing sector.
Right.
And there's something new, something we talked about in the closed session. AI. I mentioned it in the presser, but let's go deeper. We are seeing capital expenditures on data centers and energy grids that rival the Industrial Revolution. This is inflationary in the short-term demand for copper, steel, power, but deflationary in the long-term labor replacement. The Fed is trying to figure out if this AI boom is increasing productivity enough to allow us to run the economy hotter without inflation. We don't know yet. That's why we paused. If AI is a productivity miracle, maybe 3.5% isn't restrictive. Maybe it's the new normal. We're debating the neutral rate. Is it higher? With deficits at 6.4% of GDP. With the sovereign AI spending? Probably. The days of 0% interest rates are gone. They aren't coming back in my lifetime. You need to adjust your models for a world where money has a cost. Goldman Sachs pushed their cut forecast to June. The market is finally listening. We aren't providing forward guidance because we don't know. The volatility is the point. We need financial conditions to stay tight enough to finish the job. If I tell you we cut in June, stock markets rally, bond yields fall, financial conditions loosen, and inflation comes back. So I have to keep you guessing. It's not malice, it's mechanism. To the governors looking to replace me, to the shadow Fed candidates, be careful what you wish for. The chair isn't a throne, it's a pressure cooker. You are trapped between a fiscal policy that is hitting the gas deficits, tariffs, and a monetary mandate that requires you to hit the brakes. We are trying to thread a needle in a hurricane. We paused today not because we are stubborn, but because the risk of doing too much is currently lower than the risk of doing too little and seeing inflation entrench itself at 4%.
Right.
So we wait. We watch the insurance premiums, we watch the tariffs, we watch the labor softening, and we hold the line. If that makes me unpopular in the Oval Office, so be it. If that makes me a villain on real estate Twitter, so be it. My job is to make sure that when you pull a dollar out of your pocket in 10 years, it still buys something. That's the deep dive. Turn off the mic.